January delivered the fireworks, but February is testing if the show goes on. Markets may have survived the first month of the year, but February is wasting no time in testing investors' nerves. The new month opened with sharp losses across risk assets, while gold and silver are suddenly under intense pressure. With a packed week of market-moving catalysts ahead, is the volatility about to intensify? Elliot Hentov is head of macro policy research at State Street Investment Management. So Elliot, let's start with the pick for Fed chair. Are investors right to be worried about a higher for longer world under Kevin Warsh, or could he soften his reputation as an inflation hawk?
I think it's hard to believe that he was selected for his hawkish credentials. I think nothing in the track record of the presidency suggests that hawkish monetary policy is the preferred policy path. So I think that remains to be seen. I think markets may have jumped the gun on thinking that this had been a stronger. My personal view is that he was probably selected because he has very long institutional knowledge, deep track record, and therefore would have the ability as Fed chair to convince and bring the committee along with his decisions. I think that was his distinguishing characteristic.
Well, Warsh has long argued for shrinking the Fed's balance sheet, a stance that could clash with Trump's repeated calls for lower long-term borrowing costs. So how do you see that tension playing out?
I see it playing out in the sense that the balance sheet will not shrink, and that long-favored advocacy that Warsh has had will quietly be dropped by the wayside. By the way, and some of it has some very legitimate technical argumentations. The economy is much larger. It requires a larger balance sheet for the central bank. And some of them, I think, will be simply a reality that the longer end of the treasury curve is already vulnerable to bond market jitters and basically cannot absorb a shrinking Fed balance sheet without causing quite a bit of ripple effects.
Well, this Friday brings the jobs report, closely watched for signs that the labour market is re-accelerating. What are you expecting? And does it even matter if Powell seems resolute for no more cuts under his leadership?
In the near term, you're right. There's probably no figure that could come out this week that would change the near-term path of monetary policy. But the labor market is the area where I think we have the least certainty in terms of the outlook. We do think clearly growth is going to pick up. That should lead to stronger labor demand. And then the question really is, what does labor supply look like in the United States? Have the immigration measures severely hampered or constrained labor supply growth or not? And we'll find out probably later this year.
Well, let's talk about gold now. It just suffered its sharpest drop in more than a decade, with prices down as much as 10% this morning. Is this simply profit-taking after an overcrowded trade, or does it signal something more troubling?
Gold is the one area where we've seen investor worries globally express their hedging, so to speak. This feeling that there's fiscal unsustainability in the developed world, geopolitically uncertain global order, all of that was expressed through the gold price. And then we saw it broaden out to other metals, kind of proxies of gold for investors who felt like they hadn't gotten into the asset class soon enough. That speculative driver should lead to repeated bouts of volatility. Remember, it's not too long ago in October, we had a similar sell-off. And so I do think this is par for the course. Obviously, gold has outpaced everybody's, even the most bullish expectations in terms of pricing. So you would think that going forward, there would be a lower returns to be had in gold. And that means periods of prolonged drawdowns.
So finally, Elliot, oil prices slid nearly 5% after Trump said that Iran was seriously engaging with Washington. Are we heading back towards a year of oversupply and lower oil prices after this latest de-escalation?
The world has changed in the world of oil because Iran is going to remain a fragile, unstable regime. That instability means you have to have a fatter or a structural risk premium now on oil that you didn't have before. You had episodic risk on and risk off. We now have basically, and we can argue what that is that $2 a barrel, $4 a barrel, but a structural risk premium. So therefore, I think the floor for oil has moved up higher. We now expect oil to hover closer to 70 for most of this year compared to 60 at the end of last.
That was Elliot Hentov from State Street Investment Management. Don't forget, you can watch more videos on Reuters.com.